Good afternoon, everybody, and welcome to the Fat Profits webcast. We typically do it on a Thursday, but we made the decision to do it today, which is a Friday, so that we could collect the key information that came out from the Fed this week. So thank you for scheduling the time. Today, the presentation will be with Angus and Patrick, and we're looking forward to having a nice session. Disclaimer, please note that the information presented today is on a general advice basis, and before acting on any of the information or recommendations, please be sure to consult a financial advisor before doing so, and please be reminded past performance is no indication of future performance. Comments and questions, you'll have the opportunity to ask us some questions along the way. You'll see the orange arrow here. You can type those questions in, and we'll look to get through as many as we can. If you cannot hear the presenter, check your volume, check the speakers are plugged in, check your headphones, check the settings. If all of that doesn't work, please feel free to give us a call, 1-300-88-11-77. Okay, without any further ado, Fat Profits Market Update. Angus, it's nice to be with you today, and I thought we'd start off with this chart, and I think you got some comments about the NASDAQ.
Yeah, look, we've had a fairly good week. It's been a really sort of solid week. All the markets have been rallying, and I guess we got that outsized rate cut from the US, from the Federal Reserve. We got quite a lot of reassurance from Jerome Powell that recession's definitely not imminent in the US, and that they're on track for a soft landing. So yeah, I thought we'd start with this chart because obviously the NASDAQ was under a bit of pressure earlier this month and certainly last month, and we've seen a nice sort of rebound off the sort of primary uptrend and this recent sort of breakout between topside resistance. So if anything, I thought I'm sort of thinking that that the seasonal weakness that we tend to get, in September and October, I think we're pretty much through the worst of it, and the worst of the volatility is now behind the markets. Now, we do have the US election coming up. There could be some uncertainty around that, and the markets might be a little bit choppy, sort of going into October. But look, on balance, I think the technical setup for the NASDAQ is favouring a retest of the record highs in coming weeks and months, and we've certainly seen new record highs in the S&P 500 and in the NASDAQ. So all in all, I think we're tracking for quite a strong finish into the end of the year. The market is liking the fact that that we're now over the hill in the US in terms of rate. Tight monetary policy, we're now on that downward path, and I think that's going to be quite a powerful tailwind for the US stock market, but also for the international markets. I still struggle, Pat, with valuation in the US. It's expensive. It's at the top end of the historical range. But what I am thinking is that we're going to get quite a powerful rally in equities and risk-on assets into the end of the year. So, pretty upbeat at the moment.
Okay, and the rhetoric, coming out of Jerome Powell is, we got a 50 basis point cut. We may see some more cuts this year and in 2025. That should all set up quite well for the tech stocks, don't you think?
Yeah. So just on that, just as the Fed were really aggressive and they had to tighten rates rapidly and to a level that surpassed most other central banks. And just going back over this point, which I've made quite a few times, but they had to do it because the average American borrower, or 25% of homeowners in the United States, were able to fix their mortgage for 20 to 30 years. So the fact that the Fed were tightening interest rates had virtually no impact on a big chunk of the population because of that factor. Not so here in Australia, where everyone's on variable, or in the UK, where a lot of people are also on variable and only fixed out to sort of three to 5 years. So it now stands to reason that the Fed are now going to have to bring rates down faster than most other central banks. So, that's going to be a pretty powerful tailwind for the tech sector, also for the just for the broader stock market and I think risk on assets. But it's going to be a big headwind for the US dollar. And I think, we've had that sort of high conviction call that the US dollar was going to come under big pressure this year. We're certainly seeing that play out now. And, I'm looking for more weakness in the dollar heading into the end of the year.
Okay. If we now move to the next is the ASX 200, and I know you want to have a bit of a chat about this at the moment.
Yeah, I think the New Zealand, Australian stock market's looking really interesting at the moment. We'll start with Australia. I mean, the economy is not officially in recession, but try telling that to the retailers or anyone who owns a hotel or a restaurant owner. Turnovers 25% down for many of them, and it certainly feels like a recession to many businesses that are out there. Look, we've got the labour market holding up, but a lot of that's been driven by the government. It's not private sector hiring; it's public hiring, and that's keeping the economy going and keeping GDP expanding in a nominal sense. We've also got immigration, but the point I'm trying to make here really is that the economy hasn't really been fabulous for a number of businesses, and yet the ASX 200 has managed to grind and break out above that big 7,500 resistance level and make new record highs. So, the stock market is not the economy is not the stock market. The stock market is looking ahead 6 to 12 months down the track when the RBA will in fact be cutting interest rates, and that will be a powerful shot of adrenaline, I think, for the Australian economy. And I believe that the ASX 200 is at the beginning of a new bull market, which could have a number of years to run, and could take us well into the 9,000s over the next several years. We had that big bull market back in between 2000 and 2007 when the index doubled. I think we're going to see upside that would probably surprise a lot of strategists today. If I picked a number out, I think that 9,000-10,000 is entirely plausible for the ASX 200 over the next couple of years. So there's a lot to be excited about, I think, with the market. And I just want to circle back to the economy. The economy is not doing great at the moment, but things could change next year when the RBA commences cutting interest rates.
Okay, I just wanted to go back and touch a little bit on those job numbers, which kind of surprised everybody, I think, a little bit on how high they were in August. And do you think that's going to impact the RBA to kind of sit tight a little bit longer in their plan to lower rates here in Australia?
Yeah, I think it certainly changes the narrative around that rate cut that I was looking for at the end of the year. Look, I still wouldn't rule one out. That jobs number was distorted by casual and temporary hiring, and also there was a lot of government hiring in there, within the sort of the health sector and the medical sector, and just that government hiring has really pushed up, inflated that jobs number. So the private sector's hasn't been hiring anywhere near as aggressively as as the public sector. So we might see that number cool down a bit in coming months, which might reassert the case for a rate cut by the end of the year. The bond market, the futures markets are certainly pricing in the first cut by the end of December. And so I wouldn't rule it out, but you know, it looked a bit more, just a little bit more remote in terms of the probability, you know, after that hot labour market data came out.
Okay, and I know you touched on New Zealand, so I thought we'd get to your home country here, and I know you want to have a little bit of chat about what's going on there.
Well, New Zealand is in a recession. You know, they've had 2 quarters of negative GDP growth, which is the technical description for a recession. And, you know, we have to take our hat off to the RBNZ, the central bank, for moving with a rate cut about a month ago. And, you know, obviously the economy over there is slowing down. So the central bank, you know, it's sort of like the cavalry. They've arrived. We don't know how many more negative quarters of GDP growth New Zealand will go through. It could prove to be quite shallow. What I thought was really interesting is the stock market, the NZX 50, the key benchmark. You know, after a multi-year consolidation, since hitting a sort of 13,500 high back in 2020, we've had this big sort of ranging sideways consolidation. The primary uptrend continues to be respected. And, you know, from top to bottom, from peak to trough, you know, we saw the index lose nearly a third, probably not quite a third, certainly, you know, close to 30%. But it's since recovered, pushed up through near-term resistance, broken that resistance level at 12,000. That's now reasserting on the top side. This is a very bullish technical setup. So, you know, despite the fact that economy's in recession, the market is looking 12 months ahead to when the RBNZ will have put through more rate cuts, and we get potentially get a cyclical rebound in the economy later next year. So, you know, I just really wanted to emphasize it's not where the economy is today as it relates to the stock market. It's where the stock market thinks the economy is going to be in a year's time that really counts.
Okay, I thought I'd slip a question in here that I've just got through, and the question was, can we get Angus's view on the property market in New Zealand?
Yeah, I think it's bottoming. I think the commercial property market over there is bottoming as we speak. And, you know, the old saying, don't fight the Fed when they're tightening, don't fight the Fed when they're easing. Easing is good for equities. It's also good for property. And we know that those cap rates on property, on commercial property, have been under pressure as the RBNZ has tightened. Same goes for Australia. It now stands to reason that we're going to start to see commercial property make a big rebound next year. That's my one of my predictions. Letting that cat out of the bag early, Pat. That we will see quite a strong recovery next year. I think the work from home dynamic starts to recede next year. Rising unemployment will probably put paid to that. Doesn't mean to say that companies are not going to be flexible with their workforces, but I do think that the CBDs will make a big rebound in 2025. And, you know, we're already seeing a number of large companies order all their staff back 5 days a week. You know, it's happened in New South Wales government. So yeah, better days ahead for the property market. I think it's bottoming now. The other point I'd like to make is I think, you know, residential starts to reassert on the top side in New Zealand next year. I know some of the major cities have seen, you know, prices sort of come off 10 or 15%. So I think, you know, there's a bottom in the residential. I think that low has already been seen. So better times ahead for the property market. You know, we've had pretty strong residential growth in Australia. You know, a lot of that's been driven by immigration and just a housing shortage. So, you know, you'd probably have to say that we're going to see residential do better in Australia next year as well if interest rates come down and, you know, borrowing and affordability improves.
Okay, and I know this is a market that you've been watching quite closely.
Yeah, so I thought it was worth highlighting Hong Kong, because the price action over there has been quite interesting this week. We've seen the near-term resistance broken. The index is reasserted above 18,000. So I would argue that, technically the first step above the base at 17,000, which was the breakout level, is now in. And I think we're going to see a very strong finish to emerging markets into the end of the year, driven by a weaker US dollar. The emerging markets have a positive, have an inverse relationship with the US dollar. So when the US dollar goes down in value, it tends to be a very powerful sort of tailwind for emerging markets. So I think this market could surprise on the upside. We've sort of used to the headlines and the doom and gloom about the China's economy and how bad it is over there, and how winter's approaching for commodities. Well, I don't really sort of buy into that. I think bull markets are born on maximum pessimism, and we've certainly seen that in Hong Kong and China. And I think those stocks look cheap, and I think we'll probably be surprised at how well this benchmark does over the next 6 to 12 months, and indeed into the end of the year.
Speaking of China, do you think China's going to lower their rates, their interest rates over there?
Look, I think they are making it easier and easier, and they are easing monetary policy. But there's a limit to how effective that's going to be. Consumers over there, they're sitting on an enormous amount of cash. Like China's savings rate dwarfs what we've got here in Australia, what you see in the UK, and certainly what you see in the United States. And that's just because they're scared. Their property homes have gone down by sort of 30 odd percent. The stock market's been in a tailspin, and there's just not a lot of confidence, which is why they're not spending. So, the trick for the government really is to get them spending again and get the confidence up. Government doesn't want to fire the bazooka like they have in previous cycles and risk creating another bubble. That's the one thing that they don't want to do. But, I think the cumulative measures that they keep deploying, at some point, you expect that to have an impact. I think the stock market's already sensing that, and better times ahead for the economy. And we just talked about New Zealand and, the NZX 50, breaking out and looking like it's going to go back to its record highs, whilst the economy is in recession. And it's not about the economy being in recession today, but where the economy is going to be in 12 months. I think we could come up with exactly the same playbook for China, Hong Kong. And I think that we're sort of seeing the stock market is beginning to sense that better times lie ahead for the economy next year.
Okay, so you touched a little bit on the US dollar. So here's a good chart that I know you wanted to talk about.
Yeah, so the weakness in the greenback has surprised me. It really has been under a lot of pressure in recent weeks, and it's sort of resting precariously on this big support level at 100, just below, at around 100. Look, the technical setup favors one more rebound, and we might have had a decent rebound if the Fed had gone with a 25 cut this week instead of 50. But that outsized 50 basis point cut kind of sealed its fate, really. And I think if anything, heading into the end of the year, we're going to get at least another 50 basis points of cuts over there, and this will put more downward pressure on the US dollar. We've got rising indebtedness over there. The US national debt has now gone through 35 trillion. They're faced with a huge interest bill, with a lot of that long-term debt rolling off and getting replaced by more expensive new debt that's having to be refinanced at a much higher interest rate. So that's only going to accelerate. And it's hard to see, fiscal spending slowing down anytime soon, whether it's a Harris White House or whether it's a Trump White House. Fiscal spending is not going to be reined in. It's going to continue to be quite proliferate over there. So, I think at some point heading into the end of the year, we're going to see a downside break in the dollar, and that's going to provide quite a powerful tailwind for risk assets, for commodities, for emerging markets. In my view, heading into the end of the year.
Okay, so you talked about the US dollar coming off and gold and precious metals.
Yeah, so gold has an inverse relationship with the US dollar as well. It always does well when the dollar's under pressure. But, this year, the last couple of years, we've actually seen the gold price move higher in tandem with a stronger dollar. And it's now continuing to move into new record territory as the dollar weakens, which is what you would expect. A lot of that was to do with the fact that the central banks have aggressively been buying around the world. What's been interesting is China's stopped buying several months ago. They haven't been seen to be active in the physical spot market, and some of the other central banks have sort of slowed down. So one would have to say that incremental additional buying is coming from financial flows, i.e. institutional investors, retail investors, and I think this is going to be quite a big trend really in the next sort of 6 to 12 months. I think the time for precious metal equities has arrived. They've been laggards. They've underperformed spot prices for a number of years now, and they're screening cheap. So, it stands to reason that we're going to see financial flows into that sector pick up markedly. So I'm, continue to be optimistic about that. I think the other thing to mention about gold is it's also probably a flashing red light. It's going up not just because the US dollar is going down, but US credit worthiness is deteriorating, and we know that. We've already seen a couple of the major rating agencies downgrade US debt, and I think we're going to see more of those downgrades coming through next year.
Okay, we'll move on to this one here, and I know you got a little bit to talk about on silver.
Yeah, I think silver's looking really constructive technically. That's why I wanted to put this chart up. We've seen a big retest of that breakout level, which is exactly what you want to see. It's a textbook. We've seen consolidation happen since those highs of sort of mid-year, and now we're seeing silver reassert. So I wouldn't be surprised if silver really outperforms as in terms of the precious metals and indeed commodities heading into the end of the year. It wouldn't surprise me, Patrick, if prior to the end of this year we see silver break out above sort of $33, $34 and perhaps even touch 40. That's going to prove to be, absolute catnip and a big catalyst, I think, for the silver mining stocks. And we'll talk about one company a little bit later on that I really like.
Okay, this one's dear to my heart.
Yeah, Philly. Yeah, I thought I'd put this up for you, Pat. The Philly
Thanks.
Philadelphia Gold and Silver Index. And look,
Yep.
this is an index of North American gold and silver producers. And the reason I really wanted to highlight this is it's just not too late to get on board with this bull market. We just talked before about how depressed the valuations are for many of these precious metal miners, and in terms of the technical setup for the Philly Gold and Silver Index, it's finally broken that big primary downtrend. It's encountering a bit of overhead resistance around that 160 level, but the technical setup skews to the top side, and I think it's only a matter of time before we're going to get a push through that 160 resistance level and a retest of the record highs at 230. Now that's quite a big move, and I think that's coming in the next 12 months. So it's not too late to get on board. Some of these ETFs that we hold, like GDX, which is the VanEck Gold Miners exchange traded fund, or the GDXJ, the VanEck Junior Gold Miners ETF, and also SIL, which is the Global X Silver Miners ETF, which are all baskets of major gold and silver producing companies. I like those ETFs because they take away a lot of the stock specific risk that you'd have on an individual company, and so you're playing the sector and what the precious metal does more than anything.
Okay, well, this is a big topical one at the moment, and I know you got some comments on this.
Yeah, I think the iron ore price is bottoming out, and I've been sort of making that argument, as you know, Pat, in the daily for several weeks now. We can see sort of the iron ore price coming back to the primary trend, and also that big support at $90. We might see a little bit of overshooting, below that level, like we did in sort of 2023. But I don't think it'll be anything significant. A lot of those high cost producers are now shutting down production and removing supply. We also spoke about China. The Chinese economy might actually surprise on the upside next year. So yeah, I think iron ore, some of these iron ore producers, BHP, Rio, are looking really like quite attractive and quite compelling at current prices. We saw Morgan Stanley went yesterday with an upgrade on BHP and Rio, and I think I'd completely concur with that. I think those stocks look very good value at the moment.
Okay, another one that I know you've got a lot of interest in here.
Yeah, I think the copper producers are great as well, and that's obviously another string to BHP and Rio's bow. But some of the pure play copper stocks are looking really good. We've seen a decent shakeout, but nothing to worry about technically with the copper price. This is a very bullish chart. The technical setup. There's nothing wrong with what copper's done. All it's done is, it sort of overshooted when it went through resistance around that 480 level and touched 530, 540 as a lot of the hedge funds all piled in on it. And then we've had a decent shakeout, but it continues to respect this primary uptrend and that big support level at 4. So I see copper reasserting along with gold and silver and commodities generally over the next year or so. And I think that this is going to be coupled with further weakness coming in the US dollar. Dollar weakness makes commodities cheaper for the rest of the world. Not the Americans, but it makes it cheaper for just about everyone else because they're priced in dollars. So yeah, opportunities in the copper sector at the moment.
And do you see the demand for copper going up here?
Well, I think it has to, because we've got the rollout of AI. That's happening at a rapid pace. We've got data centers being built around the world to facilitate the rollout of AI. We need upgrades to the grid. We're going to need a lot more power to run all these semiconductors, these servers, the cloud, etc. With AI. So this is a trend that could go for a decade. We've also this is also coinciding with the drive to switch to renewable energy. That also requires a lot of commodities, a lot of copper, upgrades to the grid, upgrades to the transmission lines, the whole 9 yards. So, I think this is real. And we know that there just hasn't been much new mine supply in the pipeline. We know that BHP and Rio, it's sort of, building out their existing mines. But there's not a lot of new supply coming on. It takes 15 years to bring a new copper mine into production. You can't do it overnight. So no one's really going to be figuring out how to produce more copper and look for more copper and explore for it and bring a new mine on until copper prices are sort of well north of $6 or $7. At least that's my view anyway. So yeah, I think there's really good risk reward skew to the upside for a lot of those copper producers. And I think, if we look at BHP and Rio, both huge copper producers, and being, knocked around by what really is just a short-term setback for the copper price, and of course iron ore. Good opportunities exist there, Pat.
Okay, and this is the time where we're going to talk a little bit more about some stocks that you like, and we touched on that earlier in the presentation. I know there's a few here that you think look really good at the moment, and we'll start with this one, which I know you've got some interest in.
Yeah, I think, look, Alibaba really stands out. It's on a valuation or a PE of around 8 times or 9 times. I mean, this is the equivalent of a Microsoft or an Amazon or one of those huge US tech companies. It's a behemoth in China. Stocks lost a lot of ground, obviously, since topping out at sort of 320 odd US dollars back in 2020. We've had this big bear market. I think that bear market is now over. I've been encouraged by the topside break above that sort of primary sort of downtrend that occurred this week or in recent weeks. And I think the path of least resistance is now to the upside. And I think, Alibaba screens cheap. It screens really cheap. Where could it get to? Well, we could see technically, the setup now favors a retest of 100 and then 120. Those are the next important resistance levels. But I think if you put it in your bottom drawer and hung on to this one for 3 or 4 years, we could see it, significantly higher than those levels. So this is I think a really good opportunity in that the valuation is cheap, the market is cheap, the sentiment is terrible. You're essentially buying this straw hat in winter. So yeah, I really like the look of this one.
Okay, so we'll move on to our next stock that I know you want to talk about. Here we go.
I couldn't resist putting this one in there because, members have been asking us about Evolution Mining. And of course, it's a copper gold play. 30% of their revenue now comes from copper. A very bullish breakout above that sort of 420 resistance level. This has really kept a lid on Evolution now for nearly 2 years. And I think now that stock's finally pushed above that level, the next stop is 480 and 540. What's going to help Evolution get there, of course, is a recovery in the copper price, and we've just talked about that, but also the Australian dollar gold price, which also set a record this week at 3,800. And I think if we look at the Australian dollar gold price and indeed the US dollar gold price, it could have a $4,000 handle on it this time next year. So that has to be good for the local miners that have now containing their costs a lot better, a lot more constructively, and that we've got that rising spot price in the $8, also providing a big tailwind. So I think there's a lot of value in the sector.
Okay, our next stock in focus is one that I know you've been quite interested in again and hoping for a recovery in this stock.
Yeah, look, it's been under pressure because the company announced that earnings would come under pressure, and simply fast food customers are dialing back what they spend at QSR restaurants. So it's not just KFC or Collins, or it's not just KFC, it's McDonald's, it's what's the other one? Domino's. So they're all under pressure. But at the end of the day, a lot of these companies, their menus still offer quite a strong value proposition. So I think this is a short-term wobble. And indeed, when we look to next year, when the RBA is going to be cutting rates, disposable incomes will start rising again, and consumers will be feeling better and they'll be outspending. So the time to buy these high-quality businesses you know, is when sales are in profits in a little bit of a slump. We're yet to see how bad this half year is going to be for Collins, but I think, you know, under $8, the worst of the bad news is priced in. So yeah, I think if you're prepared to wait a year or so, I think Collins will be retesting its record highs, and that will coincide with the rate cut cycle that's coming in Australia.
Okay, our next stock, and I know you like this one.
Yeah, this is a silver producer. It's a big silver producer, one of the world's sort of largest pure play silver miners, listed in the US. And look, it's had a great run. You know, I've been sort of talking about this one in the daily on numerous occasions this year. We've had this big run. Look, there might be a bit of resistance from this big primary downtrend, which has been in place since 2016. But it looks like at some point, within maybe 3 to 6 months, it's going to break out above this. This will mark a significant inflection point. And, you know, we talked about silver taking out those highs from earlier this year, potentially running through to sort of $40 or thereabouts an ounce. That would probably be the catalyst for Kerr mining. And if it can break out above this primary downtrend, you know, the technical setup favors a run straight through to $11 and potentially even higher, given that, you know, back in 2016, silver prices were lower than where they are today.
That'd be a pretty big move if it got up to that level, but it's definitely possible. Here's the next stock we wanted to talk about today.
Yeah, Fresnillo. This is one for the UK members. You know, this is another one I really like, and you know, I think it's quite good buying around that. I think it's actually 580 now, so this chart's a few days out of date actually. But again, you know, like similar to Kerr mining, we've got this big primary downtrend, and I think, you know, this stock is winding up for a topside inflection and a breakout in coming months. So it's not as liquid and it's not as big as Kerr mining, but nevertheless, it's a big silver producer, and you know, it's listed in the UK, and I think, you know, this is another stock that could do well if we're right in our view that silver could test $40 an ounce in coming, you know, in the next sort of 6 or so months.
We touched a little bit on the iron ore price, and now we come to this one.
BHP. Well, you know, it has broken the primary uptrend. The thing that I quite like about this is if we look at Rio has not broken its primary uptrend. So I don't think this is anything to do with where the iron ore price is going. I think, you know, it's just due to the fact that that BHP sort of underperforming in a relative sense compared to Rio. But look, technically, it's finding support now at $38. We've had a decent bounce off that big support level. So nothing's ever certain, Pat, but you know, it's looking like it's quite a formidable support level. And I think, you know, I think we might see a few more months of consolidation, but at some point, I think BHP is going to reassert and head back and test those highs at $50. So I think quite good buying at these levels. You know, we've got copper down, but recovering nicely now after a correction. And you know, we've got iron ore, which is down as well. And we spoke about iron ore, and I don't think it's going to go too much below $90. We're seeing a lot of those high cost marginal producers shutting down. BHP makes money at $80. Their costs are amongst the lowest in the world, you know, at around $30 a ton. So, you know, what iron ore does, you know, over the next few weeks or months, I think is irrelevant, because at some point, you know, those prices are going to reassert to the top side.
Okay, and our last stock for the day.
Yeah, well, I really like the technical setup here and what Rio's done. It's had a decent pullback, from peak to trough, 30%. That sort of did surprise me. But there we have it. I don't think this stock's going it's not going below 105. This is a major support level. It represents the peak set back in 2007. And we've got this primary uptrend that continues to be respected. So, if anything, I think we've probably seen the lows in Rio. I was encouraged by Morgan Stanley upgrading the iron ore stocks yesterday. So they obviously have a similar view, and it's all about timing.
Okay, well that ends our presentation. So I thought we'd just have a chat and take a few questions. We always get the questions about the banks, Angus, and they've had a pretty good run here in Australia. Probably not a seller of them, but you're probably not a buyer, are you?
I'm struggling. I'd be struggling to buy the Aussie banks today, but they're on the watch list, and if they did sort of come back a bit, I'd be looking at buying them. I know a lot of fund managers are selling the banks and buying the resource stocks. That tends to be a big trade that perpetually plays out in the Aussie market because resources and banks dominate, are the sectors that really dominate. So yeah, look, if you've got a trading disposition, taking some profits out of some of the banks and buying BHP and Rio while they're down would probably make quite a lot of sense at this point. But I think, for longer term investors, my wife's held CBA since the float. Like, there's no point selling them and trying to buy them 10, 20% cheaper if you're, paying a whole lot of tax. So, look, I like the banks, and I think the banks, over the medium to longer term, I think the banks are going to do really well. A lot of brokers have had sell recommendations on them or underperform. They've simply been wrong. And I think what the market's sort of sensing is that the banks are going to do even better next year when the RBA starts cutting. It stimulates the demand for home loans and mortgages. Demand's going to go up there. We're going to get another housing cycle, which is all good for the banks. So, yeah, I wouldn't be buying them today, but if there was an opportunity and they did sort of succumb to a sell-off, I think they'd be on the shopping list.
Okay, and just a little, bit about the wealth management business. I know you were there and you raised a little bit of cash. Are you putting that cash back into the market now, or are you still holding
Yeah,
that?
we started deploying that cash a couple of weeks ago, and yeah, I have started putting some of that cash back to work. And the name of the game really is to be 100% invested.
Okay, and I wanted to ask you about. Yeah, I wanted to ask you about.
October.
I wanted to ask you about Microsoft.
Yeah, look, Microsoft. Sorry, the old earpiece just fell out there. Microsoft. Look, we own Apple and we own Alphabet, and we've had those stocks in the global SMA portfolio for quite some time. We've added Microsoft. I think Microsoft is going to be one of the biggest beneficiaries from AI, and all the applications that they'll be able to fold into their products. It's going to be phenomenal in terms of what they get out of the AI boom, and also the fact that the stock, technically, it's sort of come off 10 or 15%, and I was worried that it was going to go lower, but it looks like it's really sort of technically found support, and it's about to reassert to the top side. So, it wouldn't surprise me if we saw Microsoft making new record highs, well above the current high, over the coming 12 months.
Okay, had a question here. Just if Angus could just give a broad view on Japan at the moment.
Look, I like Japan. I think we've seen the worst of the short yen carry trade unwound now. It was really encouraging when we saw the yen blew through at 140 and down until the 130s. The futures were off 3%, and we came in, I think it was on Monday. Japan opened was really sharply lower, and then it had that big sort of intraday reversal. So technically, I think Japan's looking great. You know, we're getting really good economic growth coming through in Japan now. We're getting a bit of inflation, which is good for the economy. And I think the corporate sector over there, it's got the least amount of leverage in the world in major stock markets. A lot of their corporations don't carry any debt. They've got tons of cash. The buybacks are accelerating. So that's good. And Japanese investors themselves are now seeing their own stock market do well for the first time in a long time. So there's tax incentives now for Japanese to actually invest in the domestic market. So some really good tailwinds. I really like the Japanese stock market. I think, following that big shakeout, back in early August, which scared the living daylights out of all of us, when the Nikkei fell 25% in 3 days, I think that's all sort of calming down now. So it wouldn't surprise me if the Japanese stock market is back testing its record highs within 6 months.
Okay, and a question on the growth prospects and income of CSL.
Yeah, well, I'm bullish on CSL. We've added to that in our SMA portfolios. Look, CSL is a company that wrong-foots a lot of fund managers because it makes up such a big chunk of the index. It's about 6% of the index, or circa about that. If you're underweight the stock or you don't own it, when it goes on these periodic runs, these big rallies, fund managers tearing their hair out because they're underperforming it. I think CSL is on the cusp of a big re-rating cycle after multi-year consolidation where the stock has effectively done nothing and it's gone sideways in a range. I think the time has come. They made some really good acquisitions. The benefits and the financial impact of those acquisitions are really going to start flowing through to the bottom line next year. And I think that once that topside resistance level at around 310 is taken out on the top side, and it's very close to doing that, I think it's off to the races for CSL. So this is one to watch for next year.
Okay, I got one last question. You spoke about the tech sector in the US. Is there anything you're really looking at here in Australia in the tech sector?
We like Xero, which is it's an accounting software company that began in New Zealand, but has got a big global presence. It's a big global tech company, and it's got very sort of sticky recurring revenues, great growth profile, and I think they're due to report earnings later this year. This is definitely one to tech stock that we think should be a cornerstone in any Australian share portfolio.
Okay, well, that about wraps it up for today. We hope everybody all the members got some value out of the presentation. Angus, as always, it's nice to have a chat with you about the markets, and also just wanted to wish you a safe trip. I know you're going to be traveling for a couple of weeks, and I hope you enjoy your trip overseas.
Thank you, Patrick. Yeah, I will be having a non-publishing break, not next week, but the week after, which is the first week of October, which is, as you know, it's typically a break where I just put down the typewriter for a week. So I'm looking forward to that. But anyway, on that note, I'll just say bye for now and look forward to joining you. When's our next webinar, Patrick?
We'll have that probably out this week, but maybe in a few weeks' time. I know you'll be traveling, so we'll try to work that out as we move forward. But look, have a safe trip, and we'll catch up soon.
Bye for now.
Bye for now.